Trillions of dollars have been lost to stock market crashes in recent months. What exactly was the driving force for this catastrophe? And how long until everything normalizes? Join us in today's video as we hear from several Wall Street experts and their insights on the situation. After months of warning, the impending stock market catastrophe has finally arrived, and we've entered a bear market. It's been a hard few months for investors, with the largest interest rate increases for 28 years, skyrocketing inflation, instability in Europe, as well as a severely tight housing market, putting them under strain. All of these factors are having a negative impact on the forecast for the world's financial markets as we move into the second half of the year 2022. It would appear that everyone is concerned, and not unreasonably so. At this moment, everyone seems to be of the same opinion, which is that this crisis is expected to become a great deal more severe in the months to come. We have gathered the thoughts of the most brilliant thinkers on Wall Street, and they are warning us to get ready for an imminent catastrophe. Investors have the tendency to believe that the current state of the market is the worst that it can possibly get when a bear market is declared. For many people, it appears as if the worst is behind us. But according to the opinions of those knowledgeable about the issue, this may have been the situation during some of the earlier recessions, but not at this moment. Thomas Munoz, a financial life advisor at Telemus, remarked, "When you see your stock portfolio go down 20% and maybe more, investors are able to get an awakening." He continued, "I don't think we've hit a bottom," emphasizing that the data his company has seen in the first half of the year are a strong sign that the economy has suffered a prolonged slump that extends far beyond a 20% decline. Selling is occurring in waves as investors become increasingly concerned about the economy's long-term sustainability. Numerous investors are unable to accurately forecast the future direction of stock values. With additional Fed meetings anticipated for this year, the turbulent market condition will continue for some time, suggesting that even if the market recovers, more declines are on the horizon. Linda Garcia, the founder of In Laws We Trust, adds, "The market hates uncertainty. The current state of the economy is unlike anything that has ever occurred and therefore cannot be compared to anything else." Garcia states, "We could be down another 20%. Lori Van Dusen, founder and chief executive officer of LVW Advisors in Rochester, New York, agreed, "With consumer spending shifting, we should prepare ourselves for further dramatic adjustments in the market this year. The whole combination of characteristics is entirely unique in comparison to everything similar that has come prior. Add the Fed in the mix, finally raising rates, and then the geopolitical issues with the war in Ukraine, which certainly does not help inflationary pressure as far as oil, gas, and food supply goes. That's all stuff that we haven't totally felt yet. Some of that we're going to feel into 2023. Melissa Bouchillon, a certified financial planner and managing partner at Soundview Wealth Advisors, emphasized, "As we look to the second half of the year, I would expect more volatility. We could see the little run-up like we did before, but the trend and the trajectory is downward. I don't think the worst is behind us," Bouchillon added. Valuations have fallen sharply since January because investors have been selling everything they can. S&P 500 multiples dropped by 40% in May after reaching a high of over 30 times earnings a year earlier, almost mirroring the decline in multiples during the whole 2000 to 2002 downturn. This indicates that the market is correcting its values at a rate that is 3 times faster than the rate at which the internet bubble collapsed. According to Gina Martin Adams of Bloomberg Intelligence, the recent rapid decline in the stock market has made it clear how dependent the post-pandemic market rise was on the money produced by the Federal Reserve. As soon as the central bank began to reduce its bond buying program, the unraveling became extremely violent. "When easy money disappears, the bubble disappears," said Martin Adams. Growth prospects and stock ownership were two of the factors that contributed to the 1990s financial bubble. It was much more difficult to deflate. Investors all across the world have been shaken up as a result of the Federal Reserve's decision to scale back its stimulus program and throw its monetary policy into reverse gear. According to Anthony Saglimbin, a global market strategist at Ameriprise, the Federal Reserve in the United States is prepared to cause a downturn in the economy if necessary in order to bring inflation down. In a recent analysis, Goldman Sachs noted, "That's why stocks still face an elevated risk of further downside even after slipping into bear market territory." The bank further noted, "For now, equities are only pricing in a mild recession, as valuations fall amidst rising rates and a more hawkish Federal Reserve. But macroeconomic headwinds are likely to turn earnings revisions negative in the second half of the year." Although the S&P 500 has plummeted 21% in the first half of this year, making it the lowest since 1970, Goldman estimates that the index might reach 3,600 when the recession hits. This is a viewpoint that is also held by Michael J. Burry, the founder of Scion Asset Management. Mr. Burry made the observation that the S&P 500 rebounded too rapidly and excessively from the COVID-induced collapse in 2020 compared to similar market downturns. As a consequence of this, the specialist anticipates a decrease of greater than 50% over the following several months. According to Burry's projections, the impending economic collapse will be a catastrophe on a scale unmatched by any previous crashes. According to Burry, the economic crisis in 2021 will be the worst since the dot-com bubble because of a combination of elements that are detrimental to the economy. Plane crash is what Burry predicts the economy will be in 2022. And everything we've already encountered is merely a foreshadowing of what's to come, according to him. There is a growing chorus of pessimistic voices on Wall Street, even from the most well-known and well-respected optimistic investors. When it comes to Cathie Wood, a well-known bullish personality, she's concerned about the current economic downturn we're seeing. She was right on the money with many of her positive forecasts for the future in 2020. Because of this, she was able to amass an online following consisting of hundreds of thousands of people who believed whatever she said. She was feeling very confident as the Fed-driven bull market continued to propel her forward. The return on investment of her ARK Innovation Fund was approximately 157% during the first year of the epidemic, in comparison to just 18% for the S&P 500 overall. Several market observers, particularly CNBC's Jim Cramer, praised her for her brilliant performance. Cathie Wood, on the other hand, presents a gloomy picture of the stock market's future. A 67% decline in the ARK Innovations Fund's value has occurred in the last year alone. U.S. economic collapse has already begun, according to her CNBC interview recently. She confessed to underestimating the intensity and impact of inflation. Cathie Wood remarked, "We think we are in a recession. We think a big problem out there is inventories, the increase of which I've never seen this large in my career. I've been around for 45 years. We were wrong on one thing, and that was inflation being as sustained as it has been. Supply chains, I can't believe it's taking more than 2 years. And Russia's invasion of Ukraine, of course we couldn't have seen that. A weaker economy and geopolitical conflicts are putting pressure on the global markets, which are struggling to keep up with the demand for their products. There will be unparalleled instability in the United States as a result of the financial market problems that are on the way. As the United States approaches a stagflationary debt crisis, economist Nouriel Roubini, who is famed for his prediction of the global recession that occurred in 2008, asserts that the stock market is going to drop by another 50%. The recession into which the US is likely to be plunged is worse than the previous financial crisis, as the country's economy is currently showing symptoms akin to the stagflation crisis of the 1970s, as well as the crippling recession which was seen in 2008, Roubini stated. The economist went on to say that while stocks in the United States and throughout the world typically fall about 35% during a normal recession, the decline will be worse in the forthcoming financial crisis because of the joint impact of rising inflation and debt crisis. Roubini said, "Because the next recession will be both stagflationary and accompanied by a financial crisis, the crash in the equity markets could be closer to 50%. Rubini went on to say that the majority of economists are dangerously naive for believing that the forthcoming downturn would be moderate and would not last for very long. There is ample reason to believe that the next recession will be marked by a severe stagflationary debt crisis. As a share of global GDP, private and public debt levels are much higher today than in the past, having risen from 200% in 1999 to 350% today, remarked Rubini. In this case, the economist said, rising interest rates and a quick return to normal monetary policy will cause highly leveraged zombie households, companies, financial institutions, and governments to go bankrupt and default on their debts. According to current estimates, the market has lost about $20 trillion already this year alone. In addition, as the pace of the sell-off quickens, we should expect to continue receiving more depressing information in the next few days. Speculative bubbles have burst, and an economic crisis is gathering momentum. Thus, market prices have dropped drastically. Conditions aren't going to get better relatively soon. This was not predicted by Wall Street's naive optimists ahead of time. Suddenly, everything has changed. As a result of this situation, a significant number of investors who did not withdraw their money in a timely manner are currently going through an extreme level of suffering. However, Wall Street and the economy will endure much more suffering. Prepare yourself for a wild journey ahead. What do you guys think will happen in the next few months? What should the Fed do to the economy to prevent further losses? Share your thoughts on this in the comment section down below. If you enjoyed this video, please like and subscribe, and we'll see you on the next one.